Hello and welcome to episode 5 of Talking Property Tax with Julia Hartman. If this is your first time that you're watching or listening to this, Talking Property Tax is about our educational tax series that's led by Julia Hartman, who is one of Australia's leading tax experts when it comes to all things property investment taxation and also personal tax matters. Now, Julie is the founder of Inban Tax, which is a tax cooperative group of which Empower Wealth Tax and Personal Accounting is a member. Julia is also our Chief Technical Tax Advisor here at Empower Wealth. Welcome to episode 5, Julia.
Thank you, Ben. Thanks for having me.
No worries. Now, in this episode, Julia, we're going to cover off on the following topics as we lead in to a new tax year. But there have been, let's summarise those. There's been some important and critical changes to what we call the HECS debt or help debt. So we need to act quickly on that. So we'll be talking about that shortly. Superannuation contributions are always important leading into the end of the financial year. We're also going to talk about a couple of other little tax insights in our general area. Then we're going to also talk about the end of year tax strategies potentially for property investors. And we're just going to finish off with a quick reminder around your working from home tax claims and how you do all your record keeping there. So let's get straight into the show, Julia. So our first topic, which is very important because it's super timely at the moment, because something really big is about to happen to people who have a HECS or a help debt. So what is changing, Julia?
Well, it's the same every year that on the 1st of June, whatever your balance sits at, they index it for inflation to increase the balance. The big thing this year is it's probably going to be 7%.
Yeah, so just let that land for everyone. Because inflation was benign for so many years, your HECS debt wasn't something you worried about because it was sort of growing really, really slowly. But because obviously we've seen an inflation breakout, we're expecting that the government's going to announce that you're going to have to pay, or the increase is going to be 7%. And the other important deadline here, Julia, is when does this apply? Is it the 1st of July or is it earlier?
Well, that's just it. Yeah, they uplift the whole lot on the 1st of June. So, how many days have we got? Not long.
Not a lot. So you need to act quickly. But what does it mean? What can I do in terms of, now let's take one step back. So explain to people how currently HECS is paid. So it's paid as part of your annual salary. So take us through how it's worked out, and then we'll talk about what you can do about it.
Okay, so every week or whatever in your pay packet, your employer, if you filled out your form correctly, is going to deduct a bit of HECS for you. But the government knows nothing about that. They just see that as normal tax withholding. It's not until you lodge your tax return that the HECS you owe is calculated and you're given a normal tax bill for that amount. And it's fortunate because you told your employer you had a HECS debt, they take more tax out of your pay. But that's a misunderstanding. Most people think they've been paying off their HECS during the year and they haven't. So all that you've put in the year is not going to reduce that 1st of June balance. That 1st of June balance will be what happened after you paid a bit off your HECS in your last year's tax return plus any study you've done since. Now, the 1st of June balance that they apply the uplift to, I might point out, is only what you owed 11 months ago. So I didn't want to mislead there. Any studying that you've done in that year will not get the uplift factor. So before you get a chance to lodge your tax return or anything, they're looking at that old balance and saying increase by 7%. Now, if you're at the end of paying off your HECS, then if you paid your HECS all off now, you'd get effectively a 7% discount. And then even though your employer's been taking it out during the year, as soon as you lodge your tax return, you'd get all that money back. So you beg and you borrow to get that. Unfortunately, if you're not going to manage to be able to pay off all your HECS debt, then you might pay some off to get a reduced amount that's going to be uplifted at the 1st of June. But you're still going to have to pay the normal HECS that you would have already had to pay when you lodge your tax return. So that's the catch. It's more, 7% is still 7%, regardless, but it's particular for people that this is their last year. Get in and pay it before the 1st of June. and then get your refund in quickly.
So I want to start from where you were talking about there. So why do they take it out of your pay? It's really simple. They don't want to have to be debt collectors in chasing all the students around the country. So they get it taken out of your POY, so you don't even get to see it, and then they adjust for it at the end of that financial year. But in terms of that calculation is performed on the 1st of June, and that's where potentially they're going to add that 7%. So the big point here, Julie, is coming back to what you were saying is, okay, so if I do have a HECS debt and I'm able to completely pay that out because I have got some savings or whatever, I'm then going to get a refund potentially for the 11 months of tax that I paid because the ATO is going to see that my balance was actually already paid out. And so they're going to refund the amount of money that my employer has taken out over the course of the last 11 to 12 months. Got that.
Yep.
Okay. Now, what about if I still have an ongoing balance? I just want to make sure people understand that again, because I might be able to, let's say the balance is 20,000, but I can find, say, $10,000 to reduce that balance before the 1st of June down to $10,000. And that's existing HECS debt, right, from the year previous. So does that mean that they're only going to apply the 7% on the 10,000?
Yes, if you've reduced whatever the balance is at the 1st of June, but no flash refund because you still owe HECS, you're still going to pay it as calculated. That's the
Understood.
warning I need people to clearly understand. Don't go begging and borrowing for it because you're not going to be able to pay it back 2 months' time. It's still
No,
going to
but and that's okay. I mean, again, you're only getting money that you've overpaid to the ATO if you've paid out the HECS debt. But there's people with thousands of dollars of HECS debt here. This is really critical for them to be able to reduce the cost of that by 7%. And inflation is a little bit stubborn next year, and it's sitting at 4.5. That debt is then going to have another 4% or so added to it in the next year. So it makes complete sense that you'd be thinking about reducing that debt when it was so cheap money or interest was cheap at 1.5%. We'd always say, don't worry about it. Put your money in your savings account, put your money in your offset account. But in this particular case, it is really important because it is such a big number of 7%. So obviously people are now, their ears are pricked up. What should they do? How do they make a payment before the 1st of June, Julia?
Right, you're quite right, Ben. Everything we know about compounding works this way for the HECS debt, doesn't it? If you pay it down this year, it doesn't keep on compounding. But all right, now I've never had a HECS debt. Have you ever had a HECS debt?
No, I fortunately haven't had a HECS debt.
No, so I don't know how to do this. So I raced downstairs and asked one of the girls downstairs. And the first bit of advice she gave me was don't use the app. She did it 1 year and it didn't come off her balance and they actually refunded it to her. So she doesn't know what
So
she did wrong on the
that's
app,
when you say the app, you're talking about the MyGov app.
on your phone or something
Yes.
like
So
that.
don't use your mobile version, but
Yep.
you need to go to your MyGov account.
Yep.
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 Keep going.
And here's what she said. So you go to MyGov and you go to ATO services, ATO service, and then ATO homepage within your MyGov account. And then you go to the menu on the top left hand corner and you click on tax accounts, then loan accounts, and then you click on voluntary repayments. So you're looking
Ooh.
clearly for those words voluntary repayments. And then apparently it just comes along because it knows your bank account and grabs it out of your bank account.
Wow. So there's no B pay instructions, there's no direct debit instructions. What you're authorizing is a debit, a debit from your account by potentially approving that through the platform. So
Mhm.
that is quite interesting. So of course we've got some resources that we want to share in terms of we'll have a briefing notes. So if you can get to the links either on the Empower Wealth website or if you're listening to this on as a replay on the Property Couch, it'll be in the show description. And so we're going to provide some what we call briefing notes. They'll be very short and simple, but they'll give you links and accesses to some information that we'll be able to prepare to help you out there. But my also important takeaway here is it's going to come down to case by case. Now, if you're worried about paying this extra 7%, that's fair enough. But if you don't have a lot of cash flow buffer, you've got rent to pay or you've got other bills and so forth, please be mindful of that. So I would be saying to you is have a chat with your accountant. This is what they're there for. They're not just there to do tax returns. They're there to help you out to sort of potentially do some number crunching if need be, to be able to supply you that information so you can make an informed decision. But you've got to act fast. This this kicks in on the 1st of June. So if you make your repayment after that time, you haven't saved that 7% in potential interest costs, which again, year on year is going to build up if inflation remains higher for longer. So again, look at those briefing notes for some additional resources there as part of that particular story. All right, that covers off on our most pressing issue. Let's talk about topic number 2 now. Superannuation contributions before the 30th of June. Now, this is a minefield. We're going to take our time working through this because every year, and I know I do it with my accountant as well, it's like, how much have I got available? How much has my wife got available? How much have we contributed? What about additional contributions? We have a self-managed super fund, so there's lots of moving parts for us. But what I want to start off with, we're just going to break this down simply, and then we'll go through that. And if I've got any further questions, I'll ask. So here we go. What can you tell us about setting up for contributions before the 30th of June, Julia?
Right. Well, we've got a choice. Is that what you're looking for? A choice of making some for yourself, for your spouse,
That's
or
true. So sorry, my bad. What I probably should have said to the start. As accountants, Julia, you have a restriction, don't you, in terms of what you can and can't tell your clients regarding their super, because unfortunately you don't qualify as a financial planner, and so we have a little antiquated law that says if I ring up Julia and say, "Hey, Julia, you're my accountant. How much should I contribute to my superannuation before 30 June?" Can you tell me that answer?
no, I can't tell you how much without going to a financial planner and doing a full fact find so they can work out how much you can afford to put into super.
Okay, so
And, and I can't tell you which super fund to put it in that to either.
ri-
And what do you use the word? Systems not fit for purpose is how you describe this law.
yes, it's definitely a system that's not fit for purpose. So if you can't tell me how much, which I understand that's the way the law is, what can you do in terms of what, or more importantly, what's the question as a customer should I be asking my accountant that would ensure that I'm not in breach of the law, and it can inform me in terms of what I might be able to do?
Well, you'd carefully worded around the lines of, um, can you just tell me what's the maximum amount I can put into super in case I decide or get advice on what I want to? And then they can look up how much, yeah, you could look up how much your employers contributed, how much you've got in unused from previous years, that sort of stuff. They can give you, yes, you can put this maximum in, and off you go from there. And how it works for tax wise. So if you put it in this way, that tax effect, which we're about to explain, they can tell you the tax effect of it and what your cap is, but they can't tell you what to do.
All right. So if I do the wrong thing and ring up my accountant and say, "Hey, how much should I be putting into my super contribution this year?" and they say, "Well, that I can't ask for you," but if you're asking me how much is available for you to make your own informed decisions, because they can't give you advice as to how much or which super fund you should put it in if you've got multiple funds. So that's just a nice little takeaway in terms of telling you what an accountant is able to talk about when it comes to any contributions that you're going to make before 30 June. All right, let's move on now. Let's talk about the rules. Can we just have a little refresher? Because again, there's a lot of different rules around tax deductible contributions for yourself. So can you just step us through those? And this is going to take a little while because there's lots of information in here.
Yeah, okay. So most people are just looking at getting their $27,500 a year into super that they're allowed to claim a tax deduction for or use it or contribute out of pre-tax dollars through their employer. Now that 27,500 includes your employer's guarantee contributions and anything you've salary sacrificed through your employer. So you need to know how much, if you're trying to take it right up to the top, you need to know how much they've contributed so far for you. And that is a quagmire because they have a whole month to a quarter to get around to putting your super in the super fund. So just because they've said on the pay packet X super doesn't mean it's gone to the super fund. And this 27,500 is measured on what the super fund receives before the 30th of June. And a warning here, a lot of super funds just even closed down 2 days before the 30th of June. Some processes, such as Zero Super, could take up to 2 weeks to get through to the fund. So another one, get your skates on with that one. But now we've got, you need, what happens if your employer last year decided to not put your June contribution in until July, but this year they've got plenty of cash and they want the tax deduction, so they've put it in June. Now you've got 13 months worth of super sitting in there. So no point in counting up, 12 months. It should be this. If you're going to push it right up to the edge, you've got to be right on to your employer. And that's the only way you're going to be able to do it accurately, is find out when they're going. You should be able to find out easy what they did back in July. That should all be recorded in your super fund. But you're going to have to find out what they're going to put in before the 30th of June so you can do your 27,500 measurement.
Beautiful. Now, for those people who might be sort of thinking, what tax deduction are you talking about here? We're talking about whatever your PAYG tax percentage is. Remembering any contributions that go into super are only taxed at 15 cents in the dollar. So that's the benefit of basically maximising out your $27,500, because it means that if you do pay that, you will be able to get that adjusted for in your tax return, because the money that you would have received from your employer or whatever would have been paid at a higher tax rate, so you get that adjustment back. Now, so that's why it's important to be working that out with your accountant to know exactly how much you can contribute, because you don't want to be in a position where you've got that 13th month and you actually step over. I have been there once. Wasn't a big penalty. I think it was about $270 odd that I had to adjust for, but it just goes to show you that that's important to know. Now, Julia, since 2019, the financial year, there has been some changes, or what sort of contribution caps are available for those unused portions?
Right. So last year and this year, the cap's 27,500. For the years before that is 25,000. And starting from the 1st of July 2018, in other words, the 2019 year, if you didn't use up all of your 25,000 in that year, you got to save it up. You could use it in future years. So the first time you got to do that was in the 2020 tax return. Now we've got quite a few years. It's capped at only 5 years backwards, but we haven't reached that 5 years yet. So if you go again into your MyGov or ask your accountant, they can see it online, what you've done in previous years and what extra you've got available that you could contribute over and above this 27,500 and claim a tax deduction for it or take it out of before tax dollars.
So it's money that's on the table, available for you legally to take advantage of. So if you've got a little bit of extra surplus, you've had a good couple of years, you've been gainfully employed, whatever that looks like, and you want to make a meaningful contribution to super, because remember, the power of compound in this environment is only going to get better for your long-term future. This is an opportunity again to talk to your accountant about how to maximize those contributions. And again, you may actually also get a refund for money that you've already paid as part of that. So another really helpful tip there, Julia. Thank you for that. I want to now pivot and talk about the spouse contributions. So what is the relationship there, and how do the rules work around the spouse contributions?
Right, you can contribute up to $3,000 for your spouse, but they have to be on a low income spouse. They have to be on 37,000 or under assessable income. It's not taxable income, and between 37,000 and 40,000 at shades. But let's just say your spouse's assessable income's under 30,000 or 37,000, then you can contribute 3,000 for them, and you will get an 18% tax offset, which is $540. So it's 18%. So if you only contribute 1,000 for them, you get a $180 tax offset, and
Making
that
sense.
reduces the tax you have to pay otherwise. Now, the money that you put in, that 3,000, doesn't get taxed going into the super fund either, unlike the money that we've talked about in the previous one. So you don't lose the 15%. So combine the 18% tax offset and the 15% not being taxed going in, that's equivalent to 33%. So still, if you're earning more than $45,000, you're paying 34.5%. So it's still better to claim the deduction for a super contribution for yourself. Still better if you've got any cap left, put the 3,000 in your name, not your spouse's name, because you'll get a bit of tax outcome. But if your income is in a lower tax bracket than that, then you might get a better outcome for the spouse contribution, and maybe they should be making one for you too, and it goes round and comes round.
Now, I'd also should be mindful to point out, Julia, in my notes here, that in my running sheet, that with the contributions that carry forward, we should be mindful to let everyone know that if your balance is over 500,000 at 30 June from the previous financial year, you will not be eligible for those carried forward contributions. So that again highlights that getting into a regular hygiene to talking to your accountant about maximising your tax effective strategy, all legally, all above board, and then also starting to think about the spouse contributions and so forth. I mean, again, superannuation is a fantastic wealth creation vehicle. It's a tax effective way to create wealth. And so all these little nuances are really important for people to understand when it comes to these types of arrangements.
And we do have a show notes that do detail all these fine prints, because it's a minefield of bits and pieces. Thank you for picking that one up,
No,
Brent.
that's all right. We will make sure that in our briefing notes that we put some of these examples that we were talking about before, because hopefully you can pick up on them and then have a chat with your accountant about those as well. There is also another little note in here with regards to additional conditions for a spouse that must be under 75 years of age. If you just want to talk to that, please.
Oh, well, if they're over 66 years of age, they have to pass a work test, which is doing 40 hours work in any 30-day period. And they have to be, for the spouse contribution, I think it's 75. And for the co-contribution, I think it's 71. They have to be under those ages. But still, once they're over 66, they have to pass a work test too. So it's no good for your retired spouse, either of these contributions.
Doesn't look like it, and I think it also says need to have earned more than 110,000 in non-deductible superannuation contributions from the balance as at the 1st of July 2020. Must have less than 1.7 million in balance. So
Yeah,
yes.
all
So
those
again,
fine.
we'll make sure that we include those in the show description, or sorry, and I should say the briefing notes that we'll also supply as part of this update. Now, I want to talk about high income earners. We were just touching on some of those lower income earners. For those people who do enjoy higher incomes, can you share a little bit more of your wisdom in this area, Julia, please?
This is a nice little trick. Listen up if you've copped, or they hate it. So what happens to these people that are earning over 250,000? Odds are their employer guarantees already doing the full 27,500. And if then they do their tax return, and the tax office sees that their adjustable taxable income, again, not taxable income, but adjusted, a few write backs and that sort of stuff, which are detailed in the show notes, their adjustable taxable income's over 250,000. So they send out another note saying, you're not getting away with just 15% tax on that money. We want another 15% tax because you're a high income earner. And this comes after they've done their tax return. They've got a tax bill there because of their employee share scheme or whatever. And they just, it's just like the straw that breaks the camel's back. So I just, there is a trick. There is a way to get around it. Now, The reason that they get the extra 15% tax is because the super money that went into the fund got concessional treatment. It only got taxed at 15 cents in the dollar, and you got a tax deduction for it. So if it goes into the super fund and it doesn't get concessional treatment, then this won't be triggered. So you've got an income of 280,000. You want to get down under 250,000 to so that you don't trigger the extra 15%. If you've got the cash, because remember this is going to be locked away in super, you go and put 30,000 into super and you claim a tax deduction for it. Whoa, you say, because I've already used up my 27,500, my employers put it in. Yeah, they're gonna come and get you for that. But you put it in, you bring your taxable income down to 250, and let's hope that's in line with your adjustable taxable income. Then if the 30,000, when it goes into the super fund, they go, no, you're over your top. You've got to pay tax on this 30,000 as if you'd earned it in wages. You can take it out of the super fund or you can take it out of your own pocket, but we're bringing it back up to your normal tax bracket. So it didn't get treated as concessional going into the super fund. Right, so suddenly it's not in the add back. So that 30,000 deduction, if it had got concessional treatment at 15 cents on the dollar, would have been added back. You'd still be stuck at 280,000. But because they caught up with you along the way, it stays as a deduction, brings you down to 250,000. So you end up paying your normal tax rate on it, but you avoid that 15% on the other 27,500 because you stayed under 250,000. Did that make sense, Ben? Did I explain
Well,
that?
I think you did a great job. It's one of the reasons why you're one of the well-known Australian experts in this space in terms of what's happening in terms of this opportunity. Now, you've vetted it, as you said, you've legally checked it, you know your numbers, you know the rules, but it is complex. And so we do have, again, in the briefing notes, an example that will be best to be looked at. And again, that critical threshold is that 250,000 level and how you might be able to bring yourself back under that particular level there as well. Now, good luck to you if you're earning over $250,000, but just be mindful that, yep, you're going to get a second hit when it comes to your tax return. There might be a few of us who have had negatively geared properties where the interest bills have gone up significantly over the last 12 months, which might bring certainly will increase our negatively geared losses. But in terms of what's happening here in these contributions, could be interesting because it is overall, or does it actually apply to super as well?
Well, the add back to decide whether you got the 250,000, any losses in rental property are added back. So if you made a $10,000 loss and you brought it down to 240, your adjustable taxable income is still 250. The only
Ah,
thing that this does help is you might have one positively geared property and one negative geared property and some positive shares. They all get lumped together to see whether you've got a net loss or a net gain.
right. But another highlighted point there, I may have made a mistake. So now that I've just been corrected by, an elite tax agent, and that's why you need to talk to your tax accountant. And it also highlights to put all of your financial information on the table with your tax accountant because this is where they will understand and be able to navigate and adjust the levers to see what options are available there. So also knowing what sort of cash position that you're in, the ability to be able to do these types of things. It's definitely professional advice. In this particular case, it is quite sophisticated in terms of, and the timing and the approach all needs to be coordinated and in sequence. But it also just goes to highlight that there is potential, a possibility fully legally, to be able to also avoid that additional 15% tax on that additional 27,500.
And I've got to give something to the financial planners here. This is why you have an ongoing fee with them, so that each year they can sit down and juggle it up and say, well, where are you going? What can you afford? The long plan is we need more money into super or we need less money, the whole picture.
Well, that basically rounds out the high income earners. And if those of you who want to know the terminology, it's Div 293 trap is what Julia was just talking about. So if your accountant's not familiar with that, they need to get familiar with that really quickly. So that rounds out. I just also want to give a final reminder in this space around super contributions. Julia mentioned it earlier, but too often we see people missing that 30 June deadline. So it's absolutely critical that you also make sure that you get all of this done earlier and don't leave it to the last minute, because you heard Julia talk about if it misses that deadline and it's not in the account, then it's not going to take effect before 30 June, which is critical for the ATO. Final message here, again, in the briefing notes that we want to share with you, there is also a great little blog in here created by Julia that talks about, through the Ban Tax website there, it talks about how to make your own super contribution. So it's a nice little blog that will also add some value in terms of if you want to do it yourself in making those contributions, if you don't want to talk to an accountant or to a financial planner. All right, let's now move on to topic number 3, where we are just talking about some general tax return insights. The big one for me, Julia, was around why are we going to get the same amount of tax that we got last year, or is there going to be a change to that?
We're going to be very unpopular this year. We've traded so well on this low to medium income tax offset, Lamito or Leamington as they call it. And people think we're wonderful because we're getting them big refunds. But all it is that it doesn't get adjusted in your weekly pay packet. It's at the end of the year. You can get up to $1,500 back when you lodge your tax return if your income's under 126,000, though it shades out once you get up to 126. But yeah, there's always been, if your employer takes out basically the right amount, there's always been this nice fat refund to pay your rates with or something like that. The people are, and I really want to get the message out, start saving for your rates now because it's gone. It's not going to happen this year.
No,
Um,
they
yeah,
scrapped it.
and
They
please
scrapped it
don't
in
blame your
last year.
accountant.
Well, I think they scrapped it in the October budget update or whatever. He wasn't going to honour that or roll that over. So please, here's a message to all of the people out there: don't get upset with your accountant. It's not their fault. So when you get a smaller tax return this year, it's not the accountant's fault. There's just not as much free money that was given out by governments for those low to middle income tax earners as well. So that is a timely reminder for all those people thinking they're going to get these nice big fat tax returns this year. Not going to be the case. The other thing that's also important to note here, well, we want to talk about bring forward tax depreciation and payments in advance. So can you just talk to us about some of those changes in that space?
Right. Well, everyone loves a tax deduction, but remember, most of the time you're just stealing deductions from the following year. Your tax bracket should be exactly the same this year as it was in previous, as it will be next year. So 120,000 affects most people. They'll be in the 34.5 cents in the dollar tax bracket below it, 37 cents in the dollar above it. So if you're earning 125,000 and you go on a course that's related to your job and you try and claim a tax deduction for it, it was $10,000. Well, of that 10,000, you're going to get 5,000 refunded at the rate of 34.5 cents and 5,000 refunded at the rate of 39 cents in the dollar. Sorry, I said 37 before, but I'm adding Medicare levy onto it now. So let's just
Yeah, that's all right.
34 and a half
We
and
understand what you're
39.
saying. Yep.
Yep. So the idea would be you only really want to, if you're on 125,000, if you really want to get the most out of that 10,000, you pay 5,000 this year and get your bird in the hand of 39, but not any more than 5,000 because it'll take you down to the lower tax bracket. You wait until next year and you pay the other 5, and then you've got both sides of the 10 grand at 39%.
So that's a neat little trick. So just repeating that, it's basically saying that when you think about the tax scales and when those different rates kick in, because there's no change between the 22 and the 23 tax year and the 23-24 tax year, if you had paid all of that in this tax year, you would have foregone around 5% of additional tax deduction on that $5,000. So that pays for your tax return. So from that point of view, it's another little way in which you would be able to, again, legally, tax effectively, minimise your tax where possible. And that's, again, a great accountant will know where you're sitting in regards to your income thresholds and be looking for these types of little opportunities. So we thought we couldn't pass up on those two little bits of information coming into the new tax return season, the end of the financial year. Make sure that they're under consideration with your tax accountant. All right, now, obviously that was for the general public. Now let's have a quick look at what we've got for property investors leading into the end of the financial year. And we want to talk about improvements and repairs. Can you give us a little bit of a summary in this area, Julia?
Okay, well, it's very fine line between what's an improvement and what's a repair, and it makes a big difference to your tax deduction. And what's a replacement in its entirety, so it's plant and equipment. So it's very difficult to, at this time of year, go out and spend a lot of money in this area and get a tax deduction that's worthy of the amount you spent. So you don't do it unless you have to. But if you're going to, um, let's look at the type of thing. You can't improve something beyond the condition it was in when you bought it. So if you say you're looking at painting, if the house needed painting when you bought it, you're not going to get a deduction for that painting. All you're going to do is be able to write it off over 40 years, just as typical building depreciation. So um, then if you look at the plant and equipment that you might go out and buy a hot water system, now, that's got to be depreciated over 10 years, depending on whether it's electric, gas, and all that sort of stuff. But let's say 10 years. So if you buy that in June, you're not going to get very much at all this year out of the money you spend. But there is a couple of thresholds that count. Now, if it costs you less than $300 per owner of the property, then a $600 hot water system of a jointly owned property, you're going to get an immediate write-off if you buy it in June. If it's under $1,000 per owner, then you can at least depreciate it at a little bit of accelerated. You're going to get 17.5%, or I think it's 17.75, but whatever, just
Yeah.
under 18%
Yes.
deduction in the year you buy the equipment, whether you bought it in July last year or June this year, you're going to get that deduction in the first year. But that's if it's under $1,000 per owner. Now, with the $300 per owner, it's like added together. So if you go and buy 5 sets of $300 curtains, well, you're not going to qualify because they're the same thing added together. So that's your repairs, your improvements, and it's got to be like with like that you would be replacing. So let's say it is a repair. It's the tiles are starting to crack up on the floor, and they were in perfectly good condition when you bought it. So now you decide to rip those tiles up and put new ones down. As long as they're similar tiles, you're going to get a deduction for ripping the tiles up and putting new ones down. Now there's a couple of strange ones that the ATO have disallowed, like their building was subsiding and
Restumping. Yep.
something
Yep.
something like that
Yep.
that they had to do to it. That wasn't a repair; it was considered an improvement. Go figure. Yet
Yeah.
there's
Go
another
figure.
ruling where they say if you rip up the carpets and polish off the floorboards underneath, that's a repair, not an improvement.
Wowee. No, I did not know
So,
about that. Yeah, that's a repair. There you
but
go.
so if you're going to spend a big lot of money, I really think you should talk it through with your accountant before you go ahead.
Yep.
It's the
No, I think that's a
normal.
great tip there. And if I'm paying, on annual versus monthly premium, so let me say I'm paying a monthly premium up until this May on my house and contents, or maybe even my my rental protection insurances and so forth. But I want to switch to annual, and I pay that annually in May. Am I able to claim that full annual amount
Yeah,
in this financial year?
yeah,
Yep.
certainly.
So that's another potential way if you're thinking about wanting to reduce your tax liability or give a bigger refund or something along those lines. That would qualify in terms of paying annual insurance policies. You can claim the full amount even though the property is protected on that insurance policy into the new financial year. So that's also interesting. The last one I want to talk about is the PAYG withholding variation rule and that form that you can do that. And the reason why I want to talk about this one, Julia, is that we have not seen in our lifetime a correction in interest rates as steep as this one over a short amount of period. We have definitely seen higher interest rates. I'm seeing your face there in terms of
You're obviously a lot younger than me.
no, that's not true. Or I didn't yet. So I let's acknowledge the 17% interest rates that everyone was paying back in the 90s. But what I'm talking about here is we had very cheap money, and we've moved quickly into increases that has now added, in some cases, tens of thousands of dollars to interest costs. And so the reason why I wanted to raise this PAYG withholding variation form is that if you're expecting to be able to recover some of those losses, because you're going to have a negatively geared property again, or significantly negative geared if you've got increased interest costs, this is one way in which you can get access to that money through your pay packet, as opposed to waiting for that big refund at the end of the financial year.
Yeah, I dislike this because I like my clients to get a good refund at the end of the year, and then they've got to behave responsibly for it. You give them an extra $20, $30 a week, it'll get spent. But if you're struggling to make ends meet because of the increased repayments, well, then I know it is going to be used carefully. So it is one way of solving that problem, giving you that little bit extra money each week to get through. But don't forget, it's going to cost you money to do the variation, and all you're doing through that variation is getting your deduction a little bit earlier, um, not getting any more.
No, that's right. You're definitely not getting any more. You can park that money in the offset. So again, it would be a conversation with your accountant to sort of say, the juice isn't worth the squeeze, or is it worth it? Actually, in your case, your interest bill has gone up $80,000 across your portfolio of properties. So all of a sudden now, if there's school fees or a few other things that you need to cover off on, this could be a way of doing that. A couple of little tricks also for beginners, and that is you can't overstate that variation, because if you do, Julia, what happens?
Well, they usually won't let you vary the next year, so you're sort of a bit behind the eight ball playing catch up. So you be a little bit conservative with it. I think as long as you get a tax bill under $500, they won't. They'll still let you continue. But if you do stupid stuff, they
Yeah,
won't
so
let you
so
variation
so
next
that's
year.
right. Do not be too aggressive in that income variation form. My advice is to work with your accountant to submit that form and manage that process. Obviously, they'll charge a fee for their time, as they should, because it's basically putting money back in your pocket earlier rather than a big lump sum amount at the end. I accept Julia's point around the fact that if it's a small amount and you go and spend it, it hasn't been of value. But if you are disciplined and you can trap that money and put it in surplus, it's going to reduce additional interest costs on a week to week, fortnight to fortnight, or month to month basis, depending on how you are paid. So that's a couple of little important tips. Yes, Julia.
There's another little thing I'd like to say about interest, and that is to be careful if you're thinking about paying your interest in advance before the
Yes.
30th of June to get the deduction now. Remembering again, you're borrowing deductions from next year, so yeah, but you might suddenly have a high tax bracket year because you've got a capital gain.
Yeah.
Anyway, the important thing I want you to know about paying interest in advance, it is not a point of just putting the money in the loan account and saying, well, that's paying my interest in advance. You've got to make an arrangement with the bank. They've actually got to take it as interest as such, and you can't do more than 12 months in advance.
And once you're in that program, it is a cycle that you must maintain year in, year out. We set up a few through our brokerage business very early on, and most of those clients have fallen away on that. So then they've had to make that big payment when effectively they have a catch-up year in terms of what that looks like. So it's really advantageous if you've had a significant windfall year. Let's say you've knocked it out the park as a sales agent. You've got hundreds of thousands of dollars of additional income that you wouldn't have expected to get. I should say, apologies. but then the next year you're very confident that you're not going to get the same sort of commission, then that might be an argument to do that. But in reality, we don't normally recommend it to our clients as part of the advisory work we do there. So hence why yes, you can do it. The arrangement has to be set up with the bank. It's tedious. It takes a lot of time. The banks usually aren't very efficient in doing the work. From their point of view, it's one of those difficult ones that everyone wants to just shove under the carpet and not have to worry about. But it's definitely available to you. But again, talk to your accountant around that. All right.
Another
Yeah, sorry, Julia. Yes.
Another time that this strategy might be useful is if the following year you're going to have a really low income year and you might be wasting your interest deduction. An example of that would be if you were going to go travelling for the year, or if you would take maternity leave that wasn't paid or something like that. So
Yeah.
that's another planning.
Yeah.
What
So
are you
there's
doing next?
always, and we think they're the exception to the rule, but ultimately they are available to you. So as always, our messaging here is simple. Your unique circumstances are worthy of conversation with your accountant to get the best tax advice around that. All right, let's round out this update. It's been another great update with the topic number 5. Now we talked about this a little bit in the last episode number 4, around claiming working from home expenses. And so I just want to quickly remind everyone about how challenging it's going to be as opposed to previous years. Can you talk to that story for us, Julia?
Well, you're supposed to record, if you're claiming the hourly rate for working from home, you're supposed to have recorded every hour from the 1st of March. So we've sort of missed that boat on that, but you can start now and you'll get those hours, and certainly start properly next year. So that's the flat 67 cents an hour home office claim. They've really made that quite difficult. Um, as you say, you refer to the previous show where we went into that in detail. But what you can be doing now before the 1st of June is start your diaries, because you need a month's diary to make a lot of claims. So the diary these are for things that have part private use and part work related use. So you just need a diary to show what the ratio is so that the expense can be apportioned. So things to consider in that would be laptops, phone, internet, basically any expenses that have that mixture there, that you keep the diary for 1 month. Also, if you're going to claim your car on the kilometre basis, you just keep a representative month example of how many Ks you do, and you can multiply that by 12 or 11 depending on. You also need to, if you're going to have a logbook, you need to get that started now, even though you haven't got the full 3 months before the end of the financial year, as long as you've started it before the end of the financial year. Certainly do that. And speedo readings. You need them for a logbook, the speedo reading at the 30th of June, but I'd also recommend you do it anyway. You never know when it's going to come in handy for estimating fuel, for whatever. Just go out there on the 30th of June and take your speedo reading and write it down. You never know.
Oh, beautiful advice there from a tax expert. So thank you very much for that, Julia. I also want to remind everyone again in the briefing notes that I was talking about earlier, they will be available as a complement to this video or listening audio book. So just make sure, audio I should say, just make sure that you're aware of those and you can access those through the show descriptions or off the Empower Wealth website, because there are some excellent resources that I also want to highlight that Julia has built. She's got an excellent couple of worksheets there around record keeping, which you can also gain access to from the Bantax websites. And there's also a daily spreadsheet that's available as well that you can also purchase. They're very, very reasonably priced in terms of getting accessed in the shopping area of the Bantax website. Other resources I also want to talk about, so if you want to learn more about some of the amazing work that Julia has done, she's got awesome blogs, she's got booklets, there's a notice board, there's calculators, there's tracking spreadsheets, there's all this other record keeping information that's available there. So the two websites to be thinking about is Bantax, which is bantacs.com.au, or the Ask Bantax question area, which is just actually tax questions. Easy to remember that one, taxquestions.com.au. And you can potentially ask your tax questions with Julia as your tax advisor. So I just want to also remind everyone in closing out the show that this information will be available again off the Empower Wealth website. Also, these previous episodes are available on the website, also our Empower Wealth YouTube channel. And for those of you who want the listening pleasure in audio, we do bonus episodes on the Property Couch podcast, which is our weekly podcast run by Bryce and myself called The Property Couch. So that's also good to know. So thank you again, Julia, for coming on the show today and finishing off. We'll be doing episode 6 later this year. So thank you for your time and efforts in today's show.
Thank you, Ben. Thank you for having me and helping us all ban tax.
Yes. And until next week, always remember that knowledge is, until next week, until next time, always remember that knowledge is empowering, but only if you act on it. And bye for now.